Welcome everybody, and welcome to our third Thursday event, Real Estate Investing. I'm James Arnsberger, your host, and we've got really an exciting agenda tonight. A lot of what we're going to cover tonight is sort of the basics 101 from an investment strategy and financial strategy standpoint. Hold on just a second, I'm going to turn that down. And what I mean by that is it's one thing to say, I want to invest in real estate, and it's another thing to actually invest in real estate and make money and keep the money that you make. That's a whole different kettle of fish.
Okay.
And so every month we're going to do a third Thursday event. Currently, we're scheduled to do 4 p.m. Pacific Standard Time, but consensus, if we need to adjust that, we can. And we are recording this, and everybody in the next week or so will be getting a lifetime access to our platform, where you'll have a complete library of a host of other tools and cool videos, plus the exclusive access to the third Thursday. Then, following the third Thursday, usually about 2 weeks later, we're going to be doing a Saturday workshop or working group where we take the principles that we've learned on third Thursday and we actually apply them in a how-to environment. A lot of Q&A. How do you do that? What does that look like when I do that? How can I do that? And so this platform and this general vertical, if you will, on the third Thursday has the webinar feature, has the working group feature. And then just to give you a little bit of a sense of what we're going to be doing in terms of how we're going to utilize and create the functionality of this. It's really designed to help real estate brokers, agents, real estate investors, and even first-time buyers. We've got a couple of people that are first-time buyers. How do I buy a house? And if you're not working with an agent, we're going to give you contact information to John Herhold, and he'll hook you up with an agent or maybe help you yourself. What we're trying to do is be a resource and repository, particularly with all of the contraction in the real estate market that we're going to continue to see for the next probably foreseeable 3 to 5 years. Now, just because we have contraction doesn't mean we don't have opportunity. And just because we have interest rates floating around 7, maybe 8%, doesn't mean that we're barred from buying. What we have to look at is the financial metrics and how we can best position ourselves in getting into that deal in a way that will harvest not only the financial benefits, but the tax benefits, which in many cases will pay for as much as half of the property if it's structured correctly. Again, we're going to conduct a monthly webinar event, the third Thursday of every month. That's why we call it third Thursday. That way I don't get confused and forget. And then we'll do one of those working group or workshops, usually on a Saturday. That'll be 2 weeks after, and it's real case examples and how to. In addition, we're going to provide you with free consultations and any review, transactional review before you complete a transaction. None of that's going to cost you anything. I'd rather spend a little bit of time walking you through your proposed transaction before you commit, so that we can look and making sure that you're taking advantage of being positioned the right way and you're not leaving a lot of money on the table. Most of the real estate deals that I see after the fact, half or more of the profit was left on the table, and you just can't go back and get that. Once you ring the bell and you close escrow, you're pretty much done. So we want to avoid that to the extent that we can. All right, let me jump in, and we're going to start with the first consideration. This is true in any real estate, but it is particularly true in investment and development real estate. The property type or character and the investment objectives. The property type and character and investment objectives. So in other words, How you do real estate investing will decide and determine how you will be taxed along the way during your holding period and on your exit or disposition when it comes to capital gains or future income. So how you get that set up and the kind of property, its type and its character matter a significant amount in the structure that we want to design so that you have the opportunity to harvest the most in financial and tax benefits, pay the least amount in tax legally, and keep the most in your profits and capital gains on any disposition that you're going to contemplate down the road. And we can model all of that and give you a host of different what if scenarios, but it is critical that you define that part first. And I'll get into the investment objectives because that kind of controls part of the entity structure as well. So when we talk about property type / character, what we're doing is identifying the following types or character for a number of reasons, because the tax codes actually vary based on the type and character of the property. If you have a commercial property that's not residential rental, then you have a whole different set of tax rules and tax regulations that you have to follow that are unique to commercial real estate. If you have residential rental property, well, then you have a whole different character and a whole different set of tax regulations that you have to follow and pay attention to. And if you have a primary principal residence, obviously you have the gain exclusion for a married couple of $500,000. That's governed by Section 121 of the Internal Revenue Code. But what if part of your primary residence is a rental? Well, you've changed its character from that of primary residence to mixed use or hybrid use. And you have tax benefits and you have tax consequences that have to be navigated. Even if you're renting it out to a roommate, you have to take this into consideration. And so the type and character before you invest your money is critically important because it's going to govern a good part of how you're going to set up your entity structure so that you can legally navigate the financial and tax attributes and legally keep as much of your money and not have to worry about an audit if you get audited, because everything's going to be tight and in line. So let's take a little bit of a deeper dive on this next section. We start out with the type, and the general category is residential rental. We start with a residential rental, single family. You have a single family house that you bought and you're going to rent it out, and you have a holding period. We'll get to that shortly. If you're going to hold it for 12 months or less, that is going to be a short-term holding period. If you're going to hold it for 12 months and a day or more, that's going to be a long-term holding period. A multifamily duplex or triplex or fourplex, the character of that multifamily goes up to 4 units, actually 5 units. Between 5 and 12 units, it's still multifamily apartments. But in California, for example, once you hit 13 units, you have a radically different investment vehicle. Because first, you're going to have an employee, an on-site manager that has to live on the premises. And because it's California, they're going to have to be your employee, and you're going to have to pay wages. That's why we would never buy anything more than a 12 unit, probably not more than a 10 unit if I wanted to add a few ADUs to it, because I don't need another employee on rental property. I need another employee at the office, but I don't need him at the rental property. And it changes dramatically the investment strategy that we would use for a disposition or how you're going to get out of that property. And if you've got an employee on a tail with that property, you're going to have a whole host of different challenges that you probably don't have the financial bandwidth to handle. That's why these larger apartment complexes are usually held by syndications or large investment groups. The second group of type is when we get into conversions and hybrid or mixed use. You have a single family house, it's your principal primary residence, but at some point, part of it was converted to a rental, maybe to a roommate, or maybe you just converted it and moved out and now it's a full rental. Maybe it's a single family primary residence and it had an ADU, or you're going to add an ADU and the ADU becomes the rental. Or maybe it's mixed multifamily, duplex, triplex, or fourplex with ADU added. Again, multifamily apartments, 5 to 12 units with ADUs added, and multifamily with 13 units and above with ADU added. Anytime you add an ADU, you have changed the tax and financial character of the underlying asset, the real estate. And it has significant benefits, both in terms of financial and tax attributes, that we don't want to leave on the table. And so we do this analysis so that we can identify the type and character, and then we can look at those features and benefits. And then based on investment objectives and a few other factors, we're going to be able to define the type of entity structure that is going to be best suited for this investment vehicle going forward, so that you can make baskets of money and pay the lowest amount effectively in taxes, both state and federal, if you have the pleasure of living in the Socialist Republic of California and paying, I think now 13% plus a 2% investment tax. Let's talk about our investment objectives. Why are we putting our money to work? Is it that we're looking for long-term appreciated value, which will be significant in the next 3, 5, and 8 years? Even with contraction, prices are not going to come down in multifamily. They're just not. We have such a shortage, especially in California, and we have such a migration and relocation going on that we don't have enough housing. If they started building double what they're building right now, they still would be short 10 years from now. Is the investment objective to generate income and or accumulating cash? Are you going to flip it? Flip means that you're going to buy it and hold it for 12 months or less. If you're going to hold it, it's 12 months and a day or more for tax purposes. And the reason that that's important is that it changes the dynamics financially, and it changes the tax modeling radically, depending on your projected holding period. We can model every kind of holding period, but you've got to have a better idea that that property is going to be meeting a financial objective that is complementary to your investment objective. Are you going to build the cash, build the equity, wait 5 years, maximize all your tax benefits, and then Section 1031, do a tax deferred exchange? You can actually defer the gain and take the final gain, if structured correctly, to your grave and put that bill in the coffin with you when you pass away, if you do this correctly. So what we want to do is we want to be thinking, what are our investment objectives in the subject property, specifically to that property, and generally in terms of our capital and our money and our financial resources. People say, well, I invest in real estate because I want to make money. Well, you can make money a lot of ways. You can make money by appreciated value over time. You can make money by having free cash flow. You can make money by raising rents. There's a lot of ways that you can make money in real estate. What you don't want to do is lose money in real estate. And the biggest way that you lose money in real estate is not harvesting the financial and the tax benefits. Harvesting tax benefits are sort of like the biblical principle of planting seeds. And when we nourish those seeds and they sprout and grow, we're going to harvest those crops, those gains, and we're hopefully going to be able to, as good stewards, be able to keep a lot of those gains for other things that we're going to be doing. Most of the deals that I see, more than half, 60% of the profit that was potential was left on the table or paid in over and unnecessary taxes. And that's just tragic when you look at that. There's a host of reasons why that happens, but it comes down to basically 5 things. And if those 5 things happen, you're going to always end up giving up over half of your profit in unnecessary tax. All right, so that gives us a general overview of the first consideration. Now, the second side of the coin is our second consideration, our entity structure and our investment objective. Once we have our investment objective, once we know our target type and character of property that we're interested in, now comes the question, how do we do this? You don't have to have an entity. You can do this as an individual. I will tell you that when you do it as an individual, you will pay the highest amount of tax that the federal and state government will allow you to pay by paying the highest amount of income tax, the 3% federal investment tax, and the capital gain tax, and the recapture tax on depreciation, et cetera, et cetera, et cetera. It just is staggering how much tax you expose yourself or your capital to by not understanding that the entity structure will decide the type and kind of tax that you will pay. And it is something that is so critical in putting together your investment strategy as an investor in real estate. Every prudent, successful investor has an entity structure that allows them to do a lot of things without having to create a lot of entities. So we look at sole proprietor, single investor. If you have an investment objective of flipping or holding or conversion or Section 1031, I can tell you that basically every dollar of capital gain or profit, you're going to pay 53 cents of every dollar at a minimum in tax. If you're going to flip and hold it for less than 12 months, you're going to pay about 53% in tax. If you're going to hold it for 12 months or more, you're going to pay about 48%. So you save a couple of percentage just because you're holding it a little bit longer. If you convert your primary residence to a rental and then sell it, you're going to have to bifurcate your $500,000 exclusion because you won't be entitled to all of that because you didn't set it up correctly. And so you will lose part of your $500,000 exclusion, which is the same as having to pay higher tax, except it's a lot higher when you lose part of that exclusion. A conversion of a primary residence to a hybrid rental, that's something with a roommate or an ADU where you have depreciation, but you didn't set up an entity structure, then you're going to have recapture and you're going to get back into that 53, 54% that's going to go into tax. The only thing that will give you temporary relief would be a deferral under a Section 1031 exchange, but that's only going to mitigate the gain. You're not going to get any benefit on the new property because you're locked into the old depreciation, and that has to follow each property and its character. You can't change character in a 1031, so you're kind of locked in what you can and cannot do. Now, if you were a corporation, and let's say whether it's a C or an S corporation, and the corporation is a managing member of an LLC, let's say you and your wife are owners of the LLC, and you both own the stock of your corporation, but the corporation is the managing member, the corporation becomes the partner with you and your wife, so it's a partnership. And because you can disproportionately allocate profits and losses or gains to an LLC, maybe the LLC is a 2% owner of the stock in the LLC, but it gets 98% of the profit, so it never has any tax at the partnership level. That just saves you a boatload of money. All of the profits flow up to the C Corp in management fees. You recharacterize that. you do a salary, all your corporate benefits, your defined benefit plan, everything for your lifestyle provided for under your corporation, and you rinse and repeat and keep doing that and build a multi-million-dollar portfolio. And basically the government's paying about half of that in tax benefits for you to acquire real estate. This is what a lot of wealthy people do, and they've been doing this for, I've been doing this for 40 years, and I know clients that I've been doing this at least for 20 or 30 years that they've been doing this. So this is not new. None of these strategies are new. The thing that's different is that the market is such right now that it is radically important that if you want to make boatloads of cash and gain, you got to have the structure, and you can really accelerate your wealth accumulation in real estate by having the right structure. The C Corp or S Corp is such a unique feature that it really depends on other factors outside of your real estate investment objectives that decides whether or not it's an S or C Corp. And sometimes we use an SPC, which is a special purpose corporation, or a blocker corporation, because you've got other things. Maybe you've got crypto going on and you're going to make boatloads of profits and capital gains on your crypto, and you need real estate tax losses with depreciation to offset your gains in crypto so that you're not paying any tax on your crypto. So your vehicle is going to be probably a C Corp that's a blocker, and then it's going to be a shareholder in your C Corp that's a member of your LLC. That up to about $10 million a year of income, you don't need anything else, because you can do virtually anything, including develop real estate with that structure. And after you get to $10 million, you're probably going to look at something like an FLP, a family limited partnership, because you're going to want to do some estate planning. But we're not, that's a little bit advanced for what we're doing today. The basic entity structure is going to follow one of four models. It's going to follow in one of these buckets. You're going to have some consideration to a corporation and some consideration to an LLC that is going to have the ability to meet your financial and investment objectives so that you are able to do the transactions and keep more of your money and not waste it inefficiently on unnecessary tax or capital gains. So to give you the outline of a basic plan and the formula for a basic plan, your real estate investment property, if structured correctly, can be paid for with tax savings from your entity structure. In other words, about half of your cost in the property in the first 5 to 7 years of holding the property can be covered by the direct tax savings that you will generate from holding the property if you do a few things on the front end before you buy or before you sell the property. One of those things important is the cost segregation study. This is the equivalent of back in the 80s when we were doing component depreciation. It's the sum of the parts being greater than the whole. Your house is made up of two primary asset features, land and building. The land has improvements other than the building. It has lawns, it has shrubs and trees, it has sprinklers, sidewalks, driveways, fences. All of those things are 15-year assets that can be depreciated for wear and tear and give you a tax benefit on 15-year depreciation. So we do asset allocation of all of the asset groups. Your carpet, your doors, your doorknobs, your HVAC, your windows, your window coverings, all of your wiring, your sinks, your toilets, your faucets. Every component is broken down in a study and put into 5, 7, or 15-year asset groups. And whatever's left from the purchase price is the residual, goes into the 27.5-year asset group. And then we structure the management fee that's going to be paid out to the corporation, because the LLC is never going to have any taxable income. And this eliminates and reduces taxes significantly. Now you have a basic vehicle for wealth accumulation, and at the same time harvesting all of your tax benefits and tax savings. But there's more to the story. You also want to do a rent survey, which I'll come back and explain in a moment, with the asset allocation of all asset groups, with a valuation analysis of those assets as they are grouped. Then create a hybrid depreciation between the straight line method and makers. So your 5 and 7 year assets, which are going to be more than half of your property probably, we're going to deduct those over 5 years straight line, equally divided by 5 years and equally divided by 7 years. Why do we do that? Because when you dispose of the asset down the road and you sell it for capital gain, you don't have to recapture the depreciation if you use straight line method. When you use makers, the modified accelerated cost recovery system, you do have to recapture that depreciation and add it back to your gain under the tax benefit rule. So we don't want to have a lot of money sitting in that bucket for makers. We want most of it in the straight line, because if you're going to flip that property in 5 to 7 years, you're not going to have much to recapture in terms of depreciation. Again, we adjust the management fees that are going to be paid out to the corporation, which eliminates and reduces taxes significantly. The LLC and the corporation are in a partnership with you, and maybe you and your spouse. And now we have this closely held entity group that creates the vehicle for wealth accumulation and really drilling into the tax savings. I'm going to go over a couple examples, and if you were on the webinar the other day, this will be familiar. The purchase of 4 units, $979,000. It was listed for $1,250,000, I believe. It was acquired for $979,000. The gross rents at the time was $70,000 a year. It's been held for 4 years. The direct tax savings after 4 years, $280,000. So take 979 minus 279. The property only costs $700,000 and has a GSI, gross scheduled income, right now in the end of year 4 of $118,800 and a current value of $1,000,008 with no debt. With cost segregation study and a rent survey, this property was able to accumulate $190,000 in free cash, $280,000 in actual tax savings, and did 100% valuation increase based on the GSI, which is about 15x of the GSI, to get a valuation of 1.8. This property at the end of 5 years will be traded for a 1031. And it'll have a targeted value of $2.2 million in value. I know that because I did the valuation, and that equity will be traded for a 10-unit building, 10 units, 10-unit building, no debt, and the rents will be 3x of $118,800 on a 10-unit building. The rent survey is highly valuable. What it does is it analyzes per square foot of rentable square foot and space what it actually cost you pre-tax and post-tax, and what it cost you in the future value of your money on a square foot basis analysis. And so when you rent property out, it's how much livable space per square foot that you can charge. And what we do, and what other investors that we work with do, is we give the tenants one price. They don't have to pay for water, sewer, trash, gas, and electric. It's one price. If they don't want an automatic 10% rent increase every year, then they will be prudent stewards of the utilities. And actually, in most cases, the utilities after the first year went down about 15 to 20%. And we only had to raise rents maybe 5% instead of the full 10%. This is a way to analyze value, not price. We don't care about price. Price doesn't matter until you understand value. An evaluation analysis with a rent survey and a cost segregation will take a property that you invested, let's say you paid $1 million, and show you how that's a $2.5 to $3 million asset and how to get that value out of the property the right way. And when you look about the tax benefits, basically this property produced all of that free cash plus 280,000 in taxes it didn't have to pay. So about 50% of the property was covered based on this strategy. And the property is worth 100% more going into the 5th year of ownership. Purchase an SFR, single family residence, had an ADU, 577 was the closing price. Did scrape the lot, did a feasibility study, was 50 grand. So you got 627,000. Current value is $1,250,000. It's an escrow for all cash, $1,250,000. The LLC is managed by an S corp. 90% of the profits, the difference between 627 and $1,250,000, 90% of that is 560,700. That LLC will pay the S corp a management fee of 560,700 for the 4-year holding period that the property had. No capital gain on the LLC on the sale, and the profits, the 560,700, are going to be used to fund the salary, $250,000 for salary, and a $250,000 defined benefit plan contribution. That's a $500,000 deduction, and that passes through with no taxable income on the S corp because we've eaten it all up in salary and defined benefits. This is wealth accumulation at its most basic level. By setting the entity structures up and understanding your investment objectives and understanding the type and character of the property, you have more knowledge than almost any real estate professional that's been doing this for 10 years, or any EA that's been doing this for 10 years. And the sad thing is more people don't know that they can do these things. They think that they're saving a little money because they don't want to pay to have a corporation set up. So they'd rather pay 15x more to the IRS and to the state in taxes. And that's certainly their prerogative. Last one is an Airbnb. Purchase price is $900,000. Feasibility studies 15 grand. The direct tax savings model for the first 5 years will be $310,000. The LLC in this case will be managed by a C corp. 95% of the profits will be paid to the C corp. The cost segregation study and the rent survey will generate massive savings and accumulation of cash with maximum rents, no taxable income for the first 5 years, and the minimum value in 5 years will be $1,450,000, and they'll be sitting on about $300,000 in free cash. So really the property only costs them $300,000 at the end of 5 years, and none of that income will be taxable for the first 5 years. So what I like to share with people is just look at any city, your city, USA, and the world is at your feet in the terms of opportunity. Again, commercial property is different than residential, and we'll do some workshops and webinars on commercial. There's going to be a whole flood of commercial property available when all the interest rates start re-indexing in March and April next year. About $2 trillion of that debt that's going to reset, and those people are not going to be able to afford paying that interest rate on those little shopping malls or those little office buildings. And so they'll just give the keys back to the bank, and you'll be able to pick those up probably for a song and a dance. There's going to be a lot of that available. You want to make sure that you have the right entity structure before you do that, or before you sell that, so that you can keep more of your money. There is a tremendous more opportunity now than I think I've seen in 30 years in real estate if you're set up the right way. So the next step is basically you'll get the announcement of the workshop. That'll be in about 2 weeks on a Saturday. We'll do it early afternoon. If you can't attend, we'll record it and you'll get access to it. But we're going to go through the steps of how the structure is actually set up, what goes into the analysis and how that's done, and give you access to the online platform and any free analysis or consultation on a transaction that you might be thinking about or have done that you want to get a second opinion on, and look for that hidden value in the transaction that you're contemplating, or maybe that you just did, or before you sell it and give away most of your profit in tax. So I'm going to look forward, my team and myself, of serving you and your many real estate investing friends and clients and tax consulting needs. And right now I'm going to stop the video portion and we're going to open it up for Q&A, and I'll take any questions.
Hey, James, this is John. How you doing?
Somebody's got to have a question.
James, can you hear me?
Yeah, there we go.
This is John. How you doing? Great job tonight.
Hey, John.
Hey, I was at a commercial real estate conference in Chicago about a month ago, and this was for tenant rep agents, both in the industrial warehouse space and the office space. You know, you just talked about office space, and a lot of the office guys I was talking to, their business was dying with the new trend as far as people working from home,
Right.
and some of these companies giving up a lot of their office space, allowing their employees to work at home.
Right.
What are your thoughts, and do you think a lot of this commercial office space is going to be repurposed as something else, or what are your thoughts on that?
You're seeing a lot of that happening right now, and it's going to be repurposed into industrial staging for shipping and residential. We have some here in San Diego that are being repurposed right now to micro residential with shopping and restaurant facilities, micro communities. There's a lot of zoning stuff that has to get done depending on the state and the city, but California's made it a lot easier with our state legislature actually doing something and making it available for just virtually anybody that owns real estate. Here's what I'm going to say that most experts that do what I do and look at these trends are contemplating. We're looking in the next 3 to 5 years at commercial space vacancy rates north of 40 to 60%. And we're looking at a reset of interest rates starting next year for 3 years going into 2028. And when those interest rates reset, there's a building downtown San Diego right now, the monthly load carry on the interest is $2 million. Starting in April of next year, the interest carry will go to $12 million. They're going to give the keys back to the bank and they're going to walk away because they're never going to be able to afford $12 million a month in interest. It's just not. And the building is 50% vacant.
No.
It's going to be the biggest crunch. It will pale in comparison to the housing crash.
Very interesting.
You can buy a little shopping mall right now, 7 little shopping things, little strip mall that normally would sell for $2.5 to $3 million. You can get it for $900,000 right now. I suspect if you wait till January, you can get it for $500,000 when it goes into bankruptcy.
Yeah. Interesting. Okay. Thank you.
Yep. Next, who else?
Hey, James, can you hear me?
Yeah. Hi, Jason.
Hey, great presentation. I appreciate it. So, just based off that last conversation you had with, I believe it was John,
John.
Are you anticipating entering the commercial real estate market is a good idea, you know, in the near future if we do have a strong correction?
Here's the thing that I always caution about commercial. Depending on the kind of commercial and its zoning use, those are the 2 factors that I would be very, very, very aware of. Some of that zoning can be easily or administratively changed or modified, but some of it would require a conditional use permit or even a major use permit. And when you get into that and zoning issues, I'm sure that San Diego County, like a lot of places, it is not an easy process. It is a lengthy and very expensive process. So unless you have some functional utility in mind, for the commercial property within its zoning limits as it sits or stands, you really got to know real estate and that side of the equation a lot more than you would single family. So the risk tolerance is going to be much higher in terms of putting capital in something that I would not be comfortable in.
Gotcha. Thank you. Appreciate it.
Yep, you bet.
James, if possible, I have a question. You mentioned earlier when you were talking about property types that 12 or 13 unit apartment complex seems to be a sweet spot, depending on how
Right.
you handle the ADUs. We have a particular project that's 12 units and 2 ADUs. Is that
Right.
satisfactory?
Yeah,
I mean,
the
under the
question
12
is,
rule and the 13 rule.
yeah, the question is, do the 2 ADUs by legislative grace tip you over and require you to have an on-site manager? And depending on what part of the county it's in, that's probably not enough to require an on-site manager, but I would definitely be looking at that in terms of what the state regulations are.
Thank you.
Because that's half of your profit in payroll. All right, do we have any other questions? This is fun. I'm having fun.
Great stuff.
Good, awesome. All right, let me just kind of conclude with just kind of the following roadmap, if you will. Let's say that you're looking at getting into the real estate side of it as an investor. Starting the 23rd of November, effective November 23rd of this year, Fannie Mae loans, where you used to have 30% down payment requirement on a 2, 3, or 4 unit building, now you can get in for 5% down. As long as you are an owner occupied for 1 year and a day, you can get a Fannie Mae loan for 5% down. So take $1 million property times 5%, that's your down payment. If you live in the property to get that loan, you can count the rent. Let's say you buy a 4 unit, you can count the rent on the other 3 units as part of the income for qualifying to get the loan to buy the place. And if you use somebody like me that can do the valuation and the rent survey, I can give you a valuation and a rent survey that will be legitimate, that will help you actually better qualify for that loan. It's very similar to the FHA 5% down that you can do with an FHA loan. And so what we're going to see in the new economy, we're going to see 40-year mortgages. We're going to see lower down payments, and we're going to see a restructuring of the entire real estate industry, both from residential as well as residential rental and commercial. And this major reset is basically a result of the fact that we have just printed quadrillions of dollars, and we've got so much debt right now. Our interest carry on the national debt is over $2 trillion now, over $2 trillion. And inside of less than 3 years, it'll double on the current trajectory that we're on. So stuff like Bitcoin and stuff like treasuries and all of these things are all going to be significantly affected by that. But what's going to be affected more than anything else is real estate. And I would scrape, do whatever I had to do and do whatever it took to cobble together whatever I had to do to buy as much real estate as I possibly could, because it's only going to go up. It ain't going down. And unless you get up in the morning and just work to lose money, it's going to be really hard to lose any money in real estate. With these tools and this knowledge, you're actually playing a game with a huge edge that nobody else even thinks about. And so you're analyzing the property and its financial performance. You're analyzing the property and its valuation and ability to project that valuation and convert that into financial performance. And so when you look at that cash on cash return and you factor your pre-tax and post-tax benefits, 8% interest rates actually effectively are only about 2.25%, because you have to add back your direct tax savings to that number for your rate of return to be adjusted for that. So you're not paying 8%. Your effective rate is about 2.25%. Because I'm going to tell you that interest rates are they're not going back to 3% for a long time. I think we're going to settle by the end of the decade somewhere around an average of 6.5 to maybe 6.75. They're not going back to 3. Nobody believes that. Nobody believes that. So now, if we don't have any questions, what I'm going to do is just wrap up here. We'll get a link out so everybody can get a link to the recorded version. John's going to have to do a little bit of editing. And then you'll get an invite in the next couple of days to watch your email to the working group. It'll be 2 Saturdays from now. And we'll walk through the analysis and some of the forms and worksheets and kind of what that looks like, so you have a better idea of how to do this. See, the whole thing is that we empower you to be able to do this so that you don't really need to hire people to do some of this most basic stuff that you should be able to do as an accredited or qualified investor. Then when you actually need the help for some of the heavy lifting stuff and the actual planning stuff, then you've got access to us to be able to help you do that. So with that being said, have a great night. God bless everybody, and we'll see you on the workshop. Thank you very much.